Welcome to Your Wealth by Design, a low-stress, systematic approach to investing. This is my attempt to build that system. This content is for entertainment and informational purposes only. This is what works for me and may not be appropriate for you. I am not a financial advisor, and this is not financial advice, so please do your own research before making decisions with your own money. Today, the portfolio is doing very well. We are up 0.90 versus the benchmarks. MSCI is down 0.53%. The S&P is down 0.86%. And the QQQ is down 1.54%, down big today. What little rally they had on yesterday has completely given up. Going forward, I think I'm going to change the world index benchmark from MSCI to Vanguard. If you notice, Vanguard is down less today than the MSCI, and that's because this index is predominantly large and mid-cap, which is why it was more in line with the large and mid-cap. But the Vanguard index is more diversified. It includes more small caps, which is why it's down less. I think the Vanguard index is going to be a closer parallel to what I'm doing with world equity because I do have a more diversified approach. I think this will be a better benchmark going forward. Let's quickly run through what the portfolio is doing year to date. Year to date, we are down 1.50, so we have already recovered quite a bit. Vanguard is the one to beat, up 2.47%. But more red days like today, and we will catch up. The S&P is up 0.93%, but we will catch up very quickly. And the QQQ has given up almost all its gains for the year, and we will surpass this very soon. Taking a look at our portfolio on the day, let's start by looking at the top performers. Gold and silver have seen a small bump. I originally anticipated this bump on Monday. It did not happen, it happened today, but I do not think that this is going to establish a new trend. Historically, anytime there's a large crash, there is a small rally as people who perceive it to be a discount move in to buy the dip. But the rally typically only recovers about 50% of its losses. So this, maybe we can recover some of the money, but it'll typically lose steam and then can slowly start bleeding out over time. At any rate, today's top performers, silver and gold, energy, materials, small caps, and utilities. Biggest losers, wow. Even more than crypto. Wow, that's big. A diversified holding of technology is down more than a single concentrated, highly volatile asset such as crypto. That's interesting. Communications has given up, as likely, I have to check the charts, but has likely given up all of its gains from its bump on Friday. Healthcare never gets any love. Healthcare always down. Financials have given up their gain. Let's take a look at our target holding size from the model yesterday. Our largest holding, based on the strongest trend, which was consumer staples, is up, doing great. Generally, the larger holdings are green and the smaller holdings are red. Fantastic. This is a bit of a surprise upset. It's largely just because it had a one-day strong move, so it had a chance at moving up in the model. The model increased its trend to a 7% weighting. But since we slowly DCA into these moves, if the trend fails to materialize, we don't stand to lose very much. If it does, well, then we'll continue DCAing, and if it's a long-term trend, we'll benefit large from it. Let's see what's going on in consumer staples to see what the big move is today. How much staples down here? Walmart continues to rally, up huge, 3% in a day for Walmart. Costco is up, Procter & Gamble up, Coca-Cola up huge. Good old cigarettes is down quite a bit. But the majority of the 64% are up. The rotation out of tech into defensive continues. I thought the prevailing wisdom was that it was supposed to be a K-shaped economy. So that means that lower income was supposed to be struggling, which I suppose why Walmart is rallying. I guess that makes sense. Costco, I guess that makes sense. Procter & Gamble. Okay, sure. I suppose this is a result of the K-shaped economy thesis playing out. Energy was down big yesterday. It's too much to keep up with. The world is an ever-changing place. I don't try to predict it. I just follow the trends. I think it's worth pointing out that as we look at these things every day there's some sort of crisis going on, some earnings coming out. We're basically just following the wisdom of the market. Millions of people are doing research and trying to figure out where the safest place to put their money is, where the maximum growth is. When we take a look at the model in a little bit, I think it's fascinating that the model basically automates that for us. But we basically have an actively managed, crowdsourced ETF, just leaning on the wisdom of millions of individual traders. I didn't know what was going to happen today, but the model predicted that this is what's trending, and that tended to be the case. What it said was going to lose today, lost today, and what it said was going to win today, won today. It can't predict the future, so what it perceives as a trend forming may not materialize, but I think it's handling it exceptionally well. Okay, let's not spend too much time today going through the individual holdings. I think it's just largely market fluctuation and rotation. I mean, the story of the day is basically FTech being the lowest performer. Suppose we could take a look at that and just see what's going on. Okay, NVIDIA down huge. Apple down slightly. Microsoft was down huge and continues to fall. My word. Okay, at this point, this was not new information. You know, Microsoft's aggressive spending on AI was not new information. The fact that the majority of the money is going towards OpenAI was also not new information. I think people are just following each other out the door here. Negative trends are the thing. Things that are moving down tend to keep going down, and things that are going up tend to keep going up. It really is that simple. Everything just takes a hit, getting obliterated. Except for Palantir. I did hear about Palantir. Palantir is an unstoppable juggernaut. When everything is on fire, when nobody wants to touch AI, still somehow Palantir's up. And up huge. Well, not somehow. I mean, they're profitable. They continue to put up quarter after quarter, and they always exceed expectations. Back when I was picking stocks individually, I did not invest in Palantir because I didn't understand the company. I didn't understand what they do. And I was not able to understand what Palantir did until AI could break it down for me. It took the development of AI, or at least my access to AI, for someone to get an in-depth understanding and begin to wrap my head around what Palantir actually does. Their marketing material on their website was no help whatsoever. It was not clear what they did. I didn't understand the company. And it wasn't until AI made it possible to understand what an AI company does. But I wish I understood sooner, because that has been an amazing trade. But it's okay. If I had invested in this without understanding what it does, it feels nice that number go up, but I wouldn't, it would be gambling. I wouldn't understand what I was buying. I wouldn't understand what the thesis is. Anyway, Cisco up huge. Wow, Lam is down. IB down huge. Yeah, so software, hardware, it doesn't matter if it's AI related unless you are just putting up extraordinary numbers. I think we truly are in a situation where Wall Street wants to see results. Show me the money. And if you cannot show that you are generating tremendous amounts of money, then I think the free money ride is over for AI, at least for now. Who knows? We'll follow the trend if it forms. Okay. Taking a look at the model today. Fear is on the decline. The markets seem to understand where they want to put their money today. That's going to increase our DCA. It was as low as 170. We're going to go up to 190. Getting back up to that 2% week. We have been through so many ups and downs, and the way this sell is calculated is based off of traditional metrics like moving averages and standard deviations and sigma calculations, but it's too slow. I don't see the value in these metrics. They're backward looking and they're very slow. I think the measure of fear is far more productive. I think I can instantly look at my portfolio and see how the world is reacting. If everything is red, I don't see the value in waiting for the moving averages to catch up to tell me that everything is red. I do think I will keep, this one just changes from green to yellow to red. This is maybe an overarching theme for this model was my relentless pursuit in simplification. Make it as simple as possible so it can be as robust as possible. And all this does is measure whether or not we're above the 50-day moving average and the 200-day moving average. Because if we fall below the 200-day, we're basically in a bear market. But it's good to know that, but we have a long way to go before we get there, and I want to have some insight into what's unfolding before we get to the bear market. I want to incorporate the other benchmarks onto this page so that we can see at a glance our relative strength to all three. I think that would have value. All right. Moving on to today's trends, we are seeing some deviation here. Financials, it gave up its strength. It's going back down. Mid caps could see the beginning formation of a trend here. Utilities, maybe the beginning formation of a trend. Did anything get displaced? Communications, it's going to go right back down. No trend. Europe trend is still there, but it's a weaker trend. And we've got ex-Japan, so weaker trend. It's going to move down. international small caps, it's going to move down. The mining companies make up a lot of those international small caps, are industrials and energy companies. Materials moving up today. This one's becoming a relatively strong trend and emerging. Interesting. Emerging markets should be TSM and whatnot. Let's take a look at IEMG. Oh, this one's not going to let us click through. Samsung has moved up a lot. Samsung must be doing really well. It says it's down today. It says it's down quite a bit. Interesting. Maybe I'm wrong. I could have sworn Samsung was smaller, but TSM here? Huh, down as well. Am I misunderstanding here? I don't have the time to dig through every single one of these holdings and see what is causing it to move up. But the fact of the matter is that it is up on the day, and it has been moving. Over the course of a month, it's been moving, which is about what the model tracks, about a month. The model's seeing something that I think most people would not be able to see. The week doesn't look so good. The day doesn't look so good. You could see the month, but like I would have assumed that with everything AI related and tech related going down, which it is, TSM is down, Samsung's down, that this was not where you want to be, but it seems to be holding up better than the tech companies, which are in FTech. This is a negative trend. This is becoming a moderately strong negative trend, but at least for the time being, Wall Street trusts the money going into the hardware manufacturers, Samsung, TSM, and other international emerging. It's mostly Taiwan. A lot of the semiconductor industry is going to make up IEMG. They're moving in opposite direction. Tech companies and international semiconductor. Very cool. Let's take a look at FMAT. It's building a new trend. Up huge today. Small move. Big move. This is just your copper, silver, your hard metals mining company. I did read a little bit that the market is still trying to digest the appointment of the new Fed chair. Because it's not just gold that's rallying, it's the miners as well. I guess the market is battling it out. Is the debasement trade on or is it not on? They can figure that out on their own, I guess. But that explains some of the volatility. Okay, let's go ahead and update. Oh, before we do that, broken trends. FCOM, already know that. It was doing well. The trend broke on the short term, so it's going to get squished down here. It's going to have to be strong in the short term and the long term to earn its spot at the top. And then down here, we've got FTech. It looked like it was going to be able to start recovering, but that has not been the case at all. It is completely destroyed, short term, long term. It is destroyed. ETH and BTC continue to be the strongest negative trends, moving down consistently and quickly. I think it's interesting to note that silver went from a near 30% uptrend to a negative 12% downtrend so fast. Again, the model was able to adapt extremely fast to the market. I'm pretty proud of it. And we're already seeing some green days as we find these new trends. All right, let's recalculate. The model is continuing to concentrate us into consumer staples as this trend becomes more pronounced. Consumer staple has a very low volatility, which means in order to accomplish these moves, we need to have a long-term trend, and that's what's showing up. So we're going to continue to put more and more of our money into that as we DCA. Now, all at once, if this trend dies tomorrow, we're not in a bad place. But if the trend continues, we will continue to buy into that trend. Energy, okay, pretty straightforward. Most of this is the same. We're just seeing a little bit of a consolidation in the top holdings so we can increase our allocation towards consumer staples. Let's go ahead and update the holdings in the portfolio. Okay, I got the holdings updated. Let's just make sure nothing twice its target allocation. We're checking the actual size versus the target. We sell the excess to get back down to targets. Nope, we're good. No changes necessary this time. I went ahead and updated the spreadsheet itself so that I can at a glance view all the benchmarks and their relative trend strength. And through one way or another, coincidentally, they're all the same. So that makes it very easy to compare our relative strength at the moment versus all the benchmarks. What this means is that if we look at our trend scores, this is the top 50% of our portfolio, and this is the bottom 50% of our portfolio according to the target weights. If we look at the target score of each individual benchmark, which is 208, but regardless, we take that number for each of these and we measure how much of my portfolio by weight is above this trend score. And that is 58%. So currently, 58% of my portfolio is a stronger trend than these benchmarks, which leads me to be confident that I should outperform them over the long term at also on the daily too, which is basically what the series is founded on. Barring massive trend reversals like we saw in hard metals, if the majority of my portfolio is a stronger trend than these benchmarks, I should beat it, period, over any time frame. Okay, well, today the market does what it does. Every day the market opens and people argue about what the price of things should be, and then at the end of the day, they're forced to table their argument and reconcile their differences and agree upon the current value of the market. Our model takes those agreements and finds the trend. As more people either agree upon the trend or disagree, our model will adapt and we will benefit. Wherever the trend is, we will capture it and ride that trend. If there is no trend, we will be maximum diversified and await mean reversion. And the model did exactly that. It reacted very quickly to the market, found the new trend, put us in that trend, and kept us above the benchmarks. It's a very good day. I am excited and optimistic and proud of what the model is accomplished. I could tempt fate, and I should tempt fate, and say the same thing I said on Thursday of last week. If there's anything I've missed in the model, it's better we find it now than later. So, markets, do your worst. Show me something I haven't already considered so that we can learn from it, update the model, and truly be a robust, all-weather, low-effort, high results, sleep well at night portfolio. 1% of the effort, 80% of the upside. The experiment continues. Thank you for stopping by, everybody, and I will see y'all tomorrow.